Very good morning, everyone. So, welcome you all to the day number one of the revision for the UGC NET June 2025 examination. So, from today onwards, we are going to start the revision properly for the paper 1 and paper 2 commerce. So, now at this 6 a.m. every day, as I announced in the schedule, it is going to be a commerce. So, every day at the same time, commerce will be there. Today, somehow, five minutes late. Sorry for that. So let's get started. This 20 days free live, the fast track revision session. The first session for the paper 1 and paper 2, we are offering for a free only. Just you have to analyze and you have to know how the sessions are going to be there. This is why I'm just conducting the basis for a first session. Right. So in this channel or in this app, if you are for the first time, you can just join in our Telegram group and you can subscribe to our YouTube. So guys, this is the schedule. For a paper 1, in a paper 1, I will discuss. For a paper 2, now, daily morning 6 a.m. to 8:30 or 8 o'clock, or it depends upon the completion. We'll try to decide this timing, but 6 a.m. will be the 6 a.m. or 6:05 daily class will start. So every 2 days, one chapter will be completed. My revision is going to be based on properly according to the previous question papers and their topics only. I have designed the entire uh, revision so that you can cover the theory as well as the previous year questions that are according to the trend of the question paper. First 2 days is economics, second statistics, third will be business management and HRM, fourth is business finance, fifth one business environment, international business, marketing management, next after that banking, legal aspects, income tax and accounting. So these are the total units which will be covered in this course for the commerce, starting from 2nd June today and ending on 21st June. Clear cut total will be done. Now let's start with the economy. Shall I begin? Very good morning, those who are watching in YouTube, those who are watching in app. Good morning. If you give confirmation, then we'll proceed further. And those who are watching in for a free session, if you want to attend this entire revision course, so this is the prices for the paper 1 and paper 2 commerce. Both papers revision come this free CBT mock test series of 68 mock test series with explanation and revision according to the current trend of examination. Both papers is 1749. If you want only a single paper, you can take that one, paper 1 or paper 2 only. That is at 949. Just in the app only directly you can purchase. And if you have any doubt, you can approach on our WhatsApp number, which is getting scrolled. Hello, sir. First of all, unit number 3, economics. So this unit is very much known area since the class number 11 and 12. And in this unit, definite questions you can expect. If 10 questions are coming, 9 questions we can easily solve from this unit. That one question may be twisted question. That is why on a precautionary basis, at least a minimum 9 question we can able to solve if you have a conceptual clarity thoroughly. Because the one question will be out of our scope, can't be a master over the all 10 minutes, all 10 questions. So in this revision also, I will be concentrating on all the points which were asked from the 2019 to 2025 the previous year question. Question wise important as well as theory wise important things also will be covered. Let's get started. The first one. Sir, you should be active in the chat box also. Please be active in the chat box so that I will also get to understand. First of all, demand analysis. In the basics of economics, we know that microeconomics, macroeconomics, all those things were not questioning areas. So I'm not going into it. So microeconomics is about individual. Macroeconomics is about total aggregate. So what is economics? All those things are not part of the revision. Directly to the point revision. Main points revision will happen. So first, demand. What is demand? Demand is nothing but the consumer which are able to buy at each possible price during a given time period. Demand is nothing but the consumer is ready to buy, or consumer is able to buy at each possible price at a different prices in a particular time period. What is a consumer ability to buy? Willingness to pay and ability to buy are the two characteristics. Willingness to pay and ability to buy are the two important features which can fulfill the demand characteristic. So if the consumer is having ability to pay and willingness to buy, then this is fulfilling the characteristics of a demand at a different prices in a particular time period. Whatever a consumer readiness is usually a demand. And demand determinants are most important. What are the determinants of demand? Keep on typing with me so that you will be engaged. What are the determinants of demand? Various factors which will influence the demand. Like the first factor is price. Price of the related commodity, which means to be substitutes and complementary. Taste and preferences. Consumer income, consumer expectation, demonstration effect, population, and national income. Various things will be influencing the demand, which we call it as a determinants of demand or factors affecting a demand. Fine. And in this, out of the factors, two important things to be noted, which is price of related commodity. What is this price of a related commodity? Price of a related commodity are two things, substitute and the complementary. Demand and the substitute will always have a direct relation or indirect relation. First, is it a direct relation or indirect relation? Tea and coffee. Increase in price of the tea. Tea price increases, which means demand for the coffee will increase. Coffee demand will increase. And tea price decreases, demand for the coffee will come down. So is it a direct relationship or indirect relationship? There is a direct relationship. So between the two complementary goods, so between the two substitute goods, there exists a positive relationship or a direct relationship. So between the complementary goods, petrol and the car, if petrol price increases, car demand will fall down. Petrol price decreases, car demand will increase. Like this, complementary goods will be having quite opposite relationship. Quite opposite relationship or a negative relationship, you can say. Negative relationship or opposite relationship. Right? Indirect. Substitute goods are having direct relationship, as well as complementary goods are having indirect relationship, which is one of the main determinants of the demand. And demand curve, how the demand curve will be sloped downward from left to right. Demand curve always will be from left to right, slope downward. What are the reasons for this? Why it is sloped downwards, sir? What are the reason behind the slope downwards? Why this? The main reason is that law of diminishing marginal utility. Our satisfaction levels, as we consume more and more quantity of the goods, satisfaction is going to come down, which is why law of diminishing marginal utility is a primary reason. Secondary reason, substitution effect. As a people are, as the price of your tea increases, people are shifting it to coffee slowly. So demand for the tea will come down or not? When tea price increases, people are shifting it to coffee. So demand for the tea is coming down, which is the main reason for demand is falling down. Demand is falling down. So substitution effect, demand is falling down. That is, substitution effect is also a reason for decrease in demand or slope downwards. Next, income effect. When income increases or decreases, it will influence the buying behavior or buying pattern of the consumer. Obviously, when I have a low income, I will prefer the inferior or the low quality goods, more quantity of low quality. So demand for the inferior goods will be more, my income is low. When my income is increased, I will shift from that inferior goods to normal goods or a luxury goods. First, my income level increased. As the income increases, I'll try to demand more of a superior quality goods, less of inferior quality goods. Less of inferior quality goods. Right? So that is another reason. That is another reason. Where income effect also is a reason for demand curve slope downwards. Next, new buyers. For the existing product, new buyers are getting added. New buyers are buying the same product. New buyers are buying the existing product, which will increase the demand. And when the price decreases, demand will increase. When price increases, demand will decrease. So that can also influence. Old buyers also will be repurchasing the same good. New buyers will be purchasing, old buyers will be repeating the same good. So these are the 5 main reasons why the demand curve is sloped downward from left to right. Clear? Thumbs up. Madam, Giffen good is ulta. Why the Giffen good is coming now? Chalo. Exception to law of demand, where law of demand will not be applicable. The law of demand is that increase in price will decrease the demand. Decrease in price will increase the demand. Quite inverse relationship with the law of demand. But for these, there are exception to law of demand. Giffen goods. Giffen paradox is there, which Giffen bread and meat. Bread and meat example has been proved. So as the more and more price increases, even people try to spend less on the meat and more on the bread, because bread is a necessity good for them. So even though price increases, they try to increase the quantity of purchasing that bread only, which is a Giffen good. Veblen good and speculative goods, which are future price changes. Gold price is going to increase from tomorrow. Petrol price is going to increase from tomorrow. So demand for the goods will increase today. That is future price increase also. Bandwagon effect. Bandwagon effect is another reason. I will tell you the difference between bandwagon, snob effect and Veblen goods. And in case of emergencies also, law of demand will not work. In case of emergency, and when people are not even considering the price, people are ignorant about the prices, in such case also the law of demand will be failure. Law of demand will be failure in case of necessity. And here, very good morning. Please do hit a like button, those who are watching in the YouTube. Now, sir, as I told that Veblen goods and Veblen goods, bandwagon effect and snow effect. What is the difference between these three? Sir, there is a previous year question from here. PYQ point, kindly make a note of this. PYQ point here. Bandwagon effect, snow effect, as well as Veblen effect. Here, bandwagon effect. Increased demand for a good due to its popularity. Everybody going to Triple R movie. I also will go to Triple R movie. So due to its popularity, everybody started purchasing, irrespective whether it is good or bad for me, or whether the product is needed for me or not. People are just purchasing because everybody purchases. That is bandwagon effect. Bandwagon effect. People buy it because others are buying it. And snow effect means decreased demand for a good or a service as its popularity increases. When everybody purchasing, I don't want to buy because I want to be a special. I want to be a special. People avoid it because it becomes common. When everybody buying the same good, I will not buy because I am a status oriented person. I wanted to be unique. Everybody having iPhone in hand, I won't be buying the iPhone. Everybody buying OnePlus, I won't buy the OnePlus because I do not want to buy the common goods which are available in all the people hands. Right? Desire for the exclusivity. They want a status. They want a uniqueness. They want a differentiation. That is snow effect. Right? Veblen effect. Veblen effect means increased demand for a good or a service due to its high price. Highly priced goods are high quality. A psychological notion it is. A psychological notion. So people will buy to signal their wealth and status usually. Desire to display. They want to showcase their status in the society. For that, high priced goods are high quality goods and they are also conspicuous consumption. Conspicuous goods we can say, which are Veblen goods. So have you identified the difference between bandwagon, snow and Veblen? Bandwagon, snow and Veblen. This is a key difference. Now if you look at here, the exception to law of demand is completed. Changes in demand. Changes in demand. So there are two things, two specific points. Give attention over here. When the due to price, if the demand is fluctuating due to the price, then we can say on the demand curve movement will happen. Call that as a movement if it is due to price. If it is due to other factors other than the price, then we call that as a shift in demand curve. What is it? You can just see this. Here, when there is a decrease in price of a commodity, there is a increase in demand for a commodity. Increase in price of a commodity will decrease the demand for a commodity. If it is demand increases as the price decreases, we can say expansion of the demand. Expansion of the demand. If the price is increasing, demand is falling down, the demand is decreasing, then we can say contraction. When the demand increases, if price fall down, it is expansion. When the demand decreases, if the price is increasing, then it is contraction. This expansion or the contraction is happening due to price. We call this rightward or leftward as the movement on the demand curve. On the demand curve only, movement is rightward, movement is leftward. if it is happening due to change in the price. If it is happening due to change in price. Correct? If suppose increase and decrease in demand is a word which we use other than the price, like price of the related commodities such as substitutes and complementaries, due to income, due to taste and preferences, due to population, or any other determinant of demand, is influencing a demand to increase or to decrease other than the price, because price is not considered here. Other than the price, if the demand is going to increase because of other factor change, demand is shifting from one curve to another curve, right? Our demand is decreasing leftward, then it means leftward means demand is decreasing, rightward means demand is increasing. The increase or decrease in demand is happening due to various factors other than the price. We call that as an increase or decrease. We call that as shift in demand. This is movement, this is shifting. You can just read out. Movement is happening, extension, contraction due to price. Shift in demand curve due to other factors other than price, increase and decrease. बस चलो, please do hit a like button, those who are watching in YouTube. Law of demand, as we understood, there is an inverse relationship between the price and the demand, and the functional relationship between the demand equal to functional relationship of price, income, as well as the complementary goods, substitute goods, related commodities, and the technology, various things. Now, sir, demand forecasting, sir, there is a PYQ. Previous year question from this area. Previous year question from this area. Demand forecasting and their process of forecasting, the objectives of forecasting, methods of forecasting under one stretch. What is demand forecasting? Forecasting, estimating the future demand. Estimating the future demand. These are the present sales. I have done the market research based on the past, based on the previous sales, last year's sales. I have done the marketing research. I am estimating now how much sales are going to happen this year or this month. That is demand forecasting. Based on that demand, I will concentrate on my production to meet the demand. If I identify that there is a 10,000 quantity demand is there for my product, I try to produce 10,000 quantity to meet the demand. So that is how it will be useful a tool for the company. It will be a useful tool for the company, that demand forecasting, estimating the future demand. And what is a regular process? So this process is a PYQ. Arrange the following statement of demand forecasting in the order. That is a question. Very simple question, but when we see that in the examination, it will be creating a confusion. First, we'll set up the objective. You are going to forecast the demand. What is the objective behind? Is it to increase your sale? Is it to increase your market share? Is it to increase your growth rate? Is it to increase your profit? What is your motto? Set up that objective. Then determine the time. How many years of past study you are going to do, or how much time future you are going to estimate. I am considering a previous 5 years data to forecast the next 1 year sales. That is time perspective decided. Selecting a suitable demand forecasting method. Out of all these methods, select one best method which is suitable for your industry. Then collect the data based on the method requirement. You have to collect the data. After that, estimating the results that we have arrived. This is a simple process of demand forecasting. Setting the objectives, Setting the objectives, determine the time perspective, that how much past year to be considered to estimate the future, right? And setting the suitable demand forecasting methodology. Based on the method, try to collect the data, analyze the data, and get the results. And what are the primary and secondary objectives of this demand forecast? Basically, objectives are on term basis, short term, long term. If you look at the short term objective, based on the demand, our production policy will be decided. Based on the demand, the pricing also can be decided. Based on the demand, how much maximum the existing resources can be utilized. How to utilize the resources which are available to meet the demand. We will make a plan that how to utilize the existing resources effectively to meet the demand. And proper control of the sales. If we know the demand, we can able to control the sales because we will ready with the inventory in the production, finished goods processing according to the demand and the sales. We can able to do that. Supply of raw material. If I want 10,000 quantity of our demand to be outside, then at least a 12,000 production I need to do. For that I require a raw material. Regular supply of a raw material. I can arrange the finance for 12,000 quantity of production and regular availability of a labor. All these things you will be maintaining to meet the demand which we forecasted. First, why are we forecasting? We are going to get this much demand. For that, we should get all things ready. Then only we can serve the demand. Next, long-term objective. Specifically in the long-term financial management, source and application, from where we can get the amount, where we can invest. Either we can change the machinery or we can expand our business. Many things. Decision regarding the production capacity. Now we are working at a 50% capacity. We can increase to 80%, 90% by engaging more machineries, more labors, and labor requirement also. In the future, we can engage more and more. So these are basically the objectives behind the demand forecast. Sir, now the previous year question is that which of the following is a demand forecasting methods? There are 5 to 6 methods were mentioned. In that, we need to identify only which are the demand forecasting methods. Only 3 were there. That is a PY. Right? So if you can see, the chat box need to type. Keep on typing so that you will be interested. Otherwise, you will sleep. That is in the morning we are taking. Huh? Methods are categorized into 3 broad categories. Opinion polling methods, statistical methods, and remaining other methods like a barometric method, simultaneous equation. First, under the opinion polling means where we conduct the survey. Opinion polling means we want to know the opinion of the customers or the various stakeholders who are dealing with our company. Like we may conduct a consumer survey, or we may get a complete enumeration survey. Complete enumeration means who are our target population. We will approach to each and every person in the population. That is enumeration. Enumeration means detailed study of a population. Sample survey and test marketing. Next, end user survey. Complete enumeration survey, sample survey, or the test marketing, end user survey. Next, another method is that sales force method, where we collect the opinion of the sales representatives. Based on that, we can forecast the demand for our product. We can get the expert opinion, consultations are with a various expert consultants of the marketing consultant and demand forecasting consultant who are having very vast experience in our industry. We can get the demand forecasting from them also. Next, if you look at the statistical methods, trend projection. Last 5 years, sales, how it is happening. Last 5 years, 2019, 20, 21, 22, 23. A trend will be, that graph will be there now. Imagine the graph, trend. Based on that, we can forecast the future. Next, a time series analysis. We will be analyzing the historical data patterns like a trend, seasonality, and the cycle of the business. Based on that, we can estimate the future. Moving average method, which is also a time series analysis. Calculate the average of past data points. What are the previous data points are there? We will be getting a mean, which is the average. Mean, which is the average. Exponential smoothing. Exponential smoothing is another statistical method where exponential probability will be used. This method. Barometric method, it uses leading indicator to predict the future. Barometric. Barometer will be there now, like a instrument that can be used to estimate. And here, regression method. It analyzes the relationship between demand and other factors. Between the demand and other factor, the relationship will be analyzed. That is independent and dependent variable or the multivariable analysis, multivariate regression. We can do it. This is regression method. Simultaneous equation method is another one. Sir, why are we learning this method? Because these methods are demand forecasting methods. The previous year question was asked like this. So the following is the demand forecasting. Now it is almost 40 minutes. First 10 minutes you can ignore. 30 minutes I was discussing only the demand chapter. Done now. Demand basic parts is completed. Do you feel that anything got ignored in the demand? Check out the PYQ. Related to the demand, nothing was ignored. Every question, whatever asked in the PYQ from 2019 to 25, all the related points has been covered. Now let's start the elasticities. What is elasticity of demand? Elasticity of demand. Elasticity means a responsiveness. Responsiveness. For a 1% change in either a price or a price of related commodity or else any other factors or an income factor, any other factors are 1% change in these factors, how are they going to bring, or how much change is going to happen in the demand due to percentage change in a price or a price of related commodity or else income. How much demand is going to change? How much is a quantification of elasticity? Elasticity is nothing but how much responsiveness. Means it is quantifying the relationship. Demand will say that it is changing. Demand will say if price increases, demand will decrease. If price decreases, demand will increase, like that. Demand, law of demand is saying only the change. But elasticity of demand will tell us how much it is going to change. The responsiveness of the demand due to various factors like a price of related commodities, and the income. Price elasticity, income elasticity. If it is due to price, the demand is changing, that we call it as price elasticity of demand. If it is due to price of the related commodity, we call that as cross elasticity of demand. If it is due to income, then we can say income elasticity of demand. So due to price, how much demand is changing, then that is price elasticity of demand. Due to price of the related commodities such as substitute and complementary goods, how much the demand is changing, that is cross elasticity of demand. And due to income changes, how much the demand is changing, that is income elasticity of demand. Here. And we have price elasticity here. price elasticity of demand. First, there are 5 types of price elasticity: perfectly elastic, perfectly inelastic, relatively elastic, relatively inelastic, and unitary elastic. Unitary elastic are the 5 categories, right? So, in this perfectly elastic, sir, due to small change in the price, a demand is infinitely changing. This is a demand, this is a price. Price change, you can't even feel it. Small change in the price, but the demand is changing infinitely. So your elasticity of demand is infinite, which is perfectly elastic. Slight fall in price leads to infinite increase in demand, which we call it as infinity or perfectly elastic. Perfectly elastic. A small change in demand can increase the demand like anything. Small change in a price. Yes, like a stock market prices. The small fluctuations in Nifty, a 1 point fluctuation can increase the demand and decrease the demand like anything. Increase, basically. Small fluctuation, which is elasticity equal to infinity. Right? And here, perfectly inelastic. Inelastic means even though price is increasing or decreasing, we cannot find any change in the demand. That is vertical in nature. No change in the demand, whether price increasing, decreasing, price is moving from here to here or there to here. There is no change in the demand. Demand curve is constant. So demand curve is vertical here. Here it is horizontal demand curve. Horizontal demand curve. Where the demand is going to be zero. The elasticity is going to be zero. Change in price does not bring any change in the demand, which is perfectly inelastic. Perfectly inelastic. Next, relatively elastic, which are luxurious goods. Relatively elastic. Proportionate change in demand is more than the proportionate change in price. Proportionate change in demand is more than the proportionate change in price. So basically here, if you see the graph also, this is a demand, this is a price. Proportionate change in demand is more. So there is a slight increase in price. The percentage of change in price is this much only. But look at how much the demand is changing. Percentage of change in demand. Which means change in demand is more. The curve will be like flatter. Percentage change in demand is more than the percentage change in price. The curve will be flatter here. Demand. Where it is more than one elasticity. Elasticity of price is more than. And quite opposite to it. The demand, this is the price, right? A slight increase in price, the percentage change in demand, it is less as compared to percentage change in price. So percentage change in price is more than the percentage change in demand. percentage change in price is more than the percentage change in demand. So price change is more as compared to demand change. Then this will be elasticity of price. It will be a flatter. This is a flatter and this is steeper demand curve. This is steeper and this is flatter demand curve. Flatter means like this. Steeper means like this. Steeper. Elasticity of price will be less than 1. Less than 1. Price elasticity will be less than 1. Proportionate increase in demand is less than the price. Here change in price is more, here change in demand is more. Unitary elastic means, and here necessary goods will be having this. Even though price is at a very high, we will try to buy, try to buy minimum quantity. Right? And here unitary elastic, where change in price equal to in demand. Proportionately, both are equally changing. Then the curve will be rectangular hyperbola. Rectangular hyperbola. Both are equally changing. Like this. Rectangular hyperbola, the curve will come. That's it. Next. Relationship of total revenue with the price and the demand. Relationship of total revenue. Sir, please give attention to one word here. Whatever, because if you understand the word, then you will understand this chart. Otherwise, now it will create a confusion. Many times, how many times you explain this concept, people will ask the next term. That is a problem. First, you are not concentrating on the main focal point. You are concentrating. If the price is elastic, which means more than 1, that means change in demand is more than the change in price. Demand is more changing as compared to the price. If that is the situation, look at it. An increase in price will decrease the revenue. Demand is more as compared to the price. But in the law of demand, when the price increases, people tend to buy low quantity, obviously. Maybe demand is, the change in demand is more as compared to change in price. But the increase in price leads to decrease in total revenue as people are consuming less. People are purchasing less. And decrease in price leads to increase in total revenue. But this relationship holds true when elasticity more than 1, then only it will work. So total revenue moves in the direction of quantity change. Total revenue is moving in the quantity change direction. So increase in price leads to decrease in total revenue because decrease in quantity of purchase. Decrease in price will increase the total revenue because increase in quantity of purchase. How the quantity is moving, total revenue also moving in a similar direction. Number 1 point. Number 1 point. When price is inelastic means it is less than 1, which means the demand percentage change in demand is less than the price. Means price is more changing. More change is price. In this case, here due to here quantity changing more now. So how the quantity moves, total revenue also move in a similar direction. Here price change is more. So how the price is moving, the total revenue will also move in the same direction. So increase in price will lead to increase in total revenue. Increase in price leads to increase in total revenue. Decrease in price leads to decrease in total revenue. decrease in total revenue. Why? Here in this inelasticity situation, price percentage change is more as compared to demand. Even though at an increased price, people are buying more and it is increasing the revenue. It is increasing the revenue, which is like a necessity goods. Price even though increasing, I will continue to buy. That is a necessity goods nature. Necessary goods, people will continue to buy even though your price is increasing. So when elasticity more than 1, quantity demanded will be changed by larger percentage than the price. So total revenue will come down. Total revenue will come down if price increase. Price decreases, total revenue will increase. That is inverse relationship in case of elasticity. In case of inelasticity, when the impact of total revenue when price increases. When price increases, total revenue increase. When price decreases, total revenue will decrease. Sir, between inelasticity and total revenue, inverse relation. Sorry, direct relation. Whereas here inverse relation. This is inverse relation. This is inverse relation, and this is direct relation. When it is unitary means total revenue remain unchanged, irrespective of change in price. Total revenue remain constant, no change. Is it clear? Total revenue related concept. Many times this is a PYQ. Medicine is the best example. Necessary goods. Whatever the price, I want that remdesivir injection. I want that medicine. Because that's an emergency case. That is my need. That is my necessity. Without that, I cannot survive. That is the price inelastic and total revenue example. On summary, elasticity more than one total revenue and total revenue price relation. Here demand relation. When it is less than one, obviously total revenue direct relation positive. Sir, one more different kind of a question needs to be solved here. Elastic, inverse, inelastic, direct. Perfect, sir. Super. Sir, here I am showing one question with an example. This is one kind of elasticity of supply. It is not the demand, it is elasticity of supply question, slope related. How to solve this question is important. Supply function is given as Q equal to 100 plus 10P. Find out the elasticity of supply by using the point method. We have a point methods, right? Point method, arc method, geometric method, like various methods are there. In that point method, when the price is 15 rupees, so 100 minus 100, this is minus is there, minus 100 plus 10p. So minus 100, the quantity equal to minus 100 plus 10 into p. P is nothing but 15 rupees given. So that is minus 100 plus 150 is 50 rupees. 50 rupees, sorry, 50 quantity. Quantity demand is 50. Right, we got a quantity 50 and price as a 50. We want the elasticity of supply. Elasticity of supply. So here, basically, we have to go for the slope. This 10p is there now. This 10 is indicating a slope. Based on the slope, we can identify the elasticity. That 10 is indicating a slope. So here, elasticity of supply equal to slope into price divided by quantity. That is slope 10, which is given in the statement. Price is 15 divided by 50 is a quantity. 10 5s are and 5 3s. Elasticity of supply equal to 3, which is more than 1. So elasticity of supply more than 1 means this elastic. Clear? That's how. Just remember the slope into P by Q. First, we need to identify the quantity from the given equation. Later, supply elasticity equal to slope into price divided by quantity. Sir, need to have the patience. Don't always enjoy with unknown topics. Need to test the unknown topics also, because this is a crucial time. Now, what about other elasticity of demand? We have done with a price elasticity till now. Now, other elasticity. What is that? Income elasticity of demand. Due to increase in income or decrease in income, how the demand is going to change. Means income is another factor. If due to income the demand is changing, we call that as income elasticity of demand. Income elasticity of demand. Is it paper 1? Sir, don't you have any idea about what is paper 1, what is paper 2? And at least you can't you see the title also? Are you appearing for the exam seriously? So normal good first. Based on the type of goods will decide the income elasticity. First category is a normal good. Second category inferior good. Inferior good means low quality. Normal good means luxury or the superior quality. Luxury or a superior quality. Sir, inferior good. You can see, obviously, when my income increases, I will prefer more of high quality goods, which are luxurious or the normal goods. When my income is low, I will prefer more of inferior goods, which is low quality goods. Which is low quality goods. Low quality. So inferior means low quality. Somehow a type of a necessity or low, not even necessity. Necessity is different. Low quality goods. So demand quantity is less after increasing in income. So when my income increases, I will decrease the demand for inferior goods. When my income decreases, I will increase the demand for. So for inferior goods, what is the relationship? A negative relationship is there in the income elasticity of demand. Fine. Now for a normal goods, when my income increases, I will shift it to more quality. When my income is in salary is increasing, I will go to branded showroom, branded clothes, branded things. I will try to prefer, which is increasing a demand for normal goods, the luxurious goods, or the superior quality goods. Right? So when my income decreases, I will not prefer this luxury or the normal goods. So quantity of a demand increases after increasing income for this normal goods. The normal goods are unitary elastic equal to 1. Means percentage change in income equal to percentage change in the demand. Both are equal. That is unitary income elastic. And less than or inelasticity situation. Percentage change in price is more than the percentage change in income is more than the percentage change in demand. Your income change is more as compared to demand change. No change in percentage of quantity demanded in respect of percentage change in income. More income is changing as compared to demand. That is less than or inelasticity. And when the demand is changing more as compared to income change, that is more than 1 elasticity of income. More than one elasticity of income. Sir, substitutes and complementary, kindly hold on. That is not part of the income elasticity. Now we are at only inferior, superior, which is income elasticity. Hello, sir. Now cross elasticity. This is about due to income. Now, due to other factors, price of the related commodity, such as due to substitutes or due to complementary, how much the demand is going to change. Due to substitute, due to complementary, how much the demand is going to change. That is called as in cross elasticity of demand. Cross elasticity of demand. Substitute. So for a substitute, positive income, positive cross elasticity. Why? An increase in price of the tea will increase the demand for the coffee. This price coffee. Why? When my tea price increases, people are shifting to coffee. Their demand is increasing. When my tea price decreases, people are shifting from coffee to tea. Again, back to the coffee, back to the tea. Like that, substitute. Substitutes are having positive relationship. Whereas complementary is negative. Price of the car increases. Demand for the petrol will fall down. Price of the car will decrease. Demand for the petrol will increase. Because more cars are being purchased, more petrol can be demanded. Like that, negative relationship between the complementary goods. Now, if we can arrange the elasticity in a sequential order, then how the sequential order will come? Elasticity in a sequential order. Sir, you can look at inferior good is a low quality good, which is having negative income elasticity or not. Inferior good, which is negative almost. Negative means less than zero. Negative means less than zero. So inferior goods are first in. Which is negative. That means less than zero. After that, substitute is a positive. Substitute is a positive means more than zero. Substitute good in cross elasticity. Right? More than zero. Exactly equal to zero. Necessary good. So first inferior will come. Low elasticity to high elasticity. Low is inferior. After that, necessary equal to zero. Less than zero, equal to zero, and more than zero, substitute. More than zero, we have a many things. More than zero, we have a many things. Here, why we have many things? From zero, if you see, zero till the one, and more than one. This is more than, and again infinite. So exactly equal to zero, necessary goods. Fine, no problem. Or else perfectly inelastic situation. This is also called as in perfectly inelastic. No change in demand, even though change in price is there. Perfectly inelastic. Right? And 0 to 1 is there, more than 0 but less than 1. That is relatively inelastic. Change in price is more as compared to demand. Exactly equal to 1, unitary elastic. Equal to 1, unitary. After the 1, what will come? Means more than 1. Perfect, relatively elastic in nature. This is relatively inelastic. This is relatively elastic. And infinity, which is perfectly elastic. Perfectly inelastic. So if the question is specifying, or if the question is asking to arrange the elasticity in a decreasing order or increasing order from low to high, your mind should think this way. Inferior good means less than 0 or a negative. So that is the first one. And highest will be perfectly elastic. Like you can make a point 0 exactly equal to 0, 0 to 1 exactly equal to 1, more than 1 less than 0. This is inferior goods. Equal to 0 perfectly inelastic, equal to 1 unitary elastic, between this perfectly inelastic, relatively inelastic, more than this relatively elastic, and infinity perfectly elastic. Like that you should, your mind should think, then it will be easy. Now consumer behavior I'm entering into. Elasticity also completed, sir. Very sorry. Hello. Consumer behavior and utility analysis. Sir, what is utility? Basically, by definition, utility is a want satisfying capacity. Want satisfying capacity. Utils. It is measured in util. How much we satisfy. When we have a cup of tea, when we have a first sip of tea, first sip of tea or a coffee in the morning when you are taking, how you get a feeling, that is called as an utility. The satisfaction. I want a tea. That want, how much it is satisfying. The want, how it is satisfying. It is called want satisfying capacity, called as an utility. Utility basically. Right? And here there are two category of utility. Cardinal, ordinal. And the cardinal utility is, cardinal utility is also called as a Marshallian utility. Alfred Marshall has given, where we can measure the utility in numbers. I have taken 5 ice cream. It have gave me good satisfaction. 5 ice cream. Like I can measure it in numbers. Ordinal utility means I cannot measure it in numbers. This was given by Hicks and Allen. This is Marshall and this is Hicks and Allen. I can keep the order of satisfaction. Like ice cream 1, I have got more satisfaction than the ice cream 2. Ice cream 2 got more satisfaction than ice cream 3. Like that, I can keep it in an order of satisfaction. I cannot exactly measure how much satisfaction I have got in number, but I can give a preference that ice cream 1 gave me full satisfaction than ice cream. Like that, I can give it a sequence or the order. Here, this is also called as an indifference curve analysis. The ordinal utility analysis given by the Hicks and Allen is an indifference curve analysis. Cardinal is an Alfred Marshall. Law of diminishing marginal utility. What are the law of diminishing marginal utility? Law of diminishing marginal utility. Sir, if any paid member leaving the class in between, I am literally warning you. Because if you leave in the middle now for this 20 days, I will not even allow for the next class. I literally block you, because why you pay for the course? Coming and going is not at all useful for you. At least for this last 20 days, you have to be active. Now we entered into red zone. This red zone should be active. If you are wasting time now also, if you are not going to watch the recording, if you cover by yourself, you cannot cover this much in detail. That is for sure. I'm just summarizing all the concepts together. Try to understand that intense. Paid members, long-term batch specifically. Rajvika batch members. Law of diminishing marginal utility means basically the law itself is the more quantity we consume, slowly the utility will decline. This utility will reduce, which is called diminishing marginal utility. The name itself is like that. Utility. The assumptions of this law is that utility is measurable because it is cardinal approach. It is measurable. Number. Units are homogeneous. Yes. If I am consuming ice cream, means ice cream 1, ice cream 2, ice cream. All are same product. And same quantity also. Unit is homogeneous. Measurement unit. Possibility of increase or decrease in demand. Yes, it can increase or it can decrease. And after one consumption, after first unit consumption, second unit, means there is no time gap. Next, no change in the income. Then only this law will work. No change in the price. No change in the taste and preference. And substitute price are also no change. If all these assumptions work, then only law will work. If any of this assumption is not working, if any of this assumption is not satisfied, then law will fail in practical world. So if all these assumptions are satisfied, then only. That is, I think, your problem, Aditi Singh, maybe. Because on the app, the people are watching. Here, 61 members are there in a YouTube. In the app, there are 57. 57 members are watching in the app. So they don't have any problem. Some issue will be there. Just you can log out and log in later on after that. Diminishing marginal utility. Right? And what are the exception where the law of diminishing marginal utility will not work? Law of diminishing marginal utility will not be applicable to drinkers. It will not be applicable to drinkers. And in case of rare collection, the more you collect, the more satisfaction. Historical coins, old rupee coins, old currencies. The more you collect, more satisfaction. Never ending. And education, the more knowledge you gain, the more satisfaction. Miser, money savers, the more you save the money, the more satisfaction. So these are all quite opposite to the law of diminishing marginal utility. Right. So in law of diminishing marginal utility, other than the cardinal measurement and independent utility, marginal utility of a money is constant. This is the PYQ. Marginal utility of a money is constant. Money marginal utility. Next here, if you see law of diminishing marginal utility, sir, first total utility, how will you calculate? First unit, second unit, third unit, fourth unit, fifth unit, like that, all the units utility that if you can combine, you will get the total utility. You will get the total utility. You can see first utility you got is 8, second 14, third 18, fourth is 20. Like the total, how much total put together you got? Here -2 when the utility decrease. So maximum utility that you have got is 18 total. 8 plus 6. plus 4 plus 2 plus 0 minus 2. Total utility. So marginal utility is nothing but change in utility by consumption of one more additional unit. From first ice cream to second ice cream. First ice cream I got a 8 utils of satisfaction. Second ice cream I got a 14 utils of satisfaction. Which means 8 to 14, what is the difference? 6. The 6 is a marginal or additional utility by consuming one more ice cream. So marginal utility is basically total utility minus previous utility. Total utility of the second ice cream minus total utility of the first ice cream, which is 8. This 6 is a additional utility by consuming one more ice cream. Right? When marginal utility tends to diminish as more commodity is consumed. Basically, marginal utility will keep on decreasing. As you increase more and more number of units, marginal utility will come down slowly. Marginal utility will come down slowly. So here, total utility when reaches maximum, exactly at the same place, marginal utility will become 0. At the point of saturation, marginal utility will be 0. At that point, total utility will be maximum. Please type this. This is a PYQ. Where marginal utility is 0, their total utility will be maximum or saturated. When total utility started decreasing, marginal utility will tend to be negative. Marginal utility tend to be negative. Right? Total utility become maximum, then marginal utility is 0. Marginal utility determines the rate of change in total utility. Right? So when total utility positive, marginal utility remain negative or 0. Because if the total utility is falling down, but still positive. But here, marginal utility becoming 0 and negative. Perfect. Law of equimarginal utility. Law of equimarginal utility, which is second law of 𝐻𝐿. 𝐻𝐿 first law is that law of diminishing marginal utility. Right? So your TU and MU relationship. When TU increases at an increasing rate, MU increases. When TU increases at a decreasing rate, MU will fall. When TU reaches maximum, MU is 0. When TU decreases, MU will be negative. Law of equimarginal utility. Here, the point is that this is the second law of 𝐻𝐿. In order to get a maximum satisfaction, consumer should spend limited income on different commodities in such a way that, so the limited income, whatever is available, 100 rupees is in my pocket, I should distribute to chocolate, ice cream and other one. Like that, to satisfy my need or to increase my satisfaction, I should use the resources effectively. Right? On a different commodities, I am putting my limited income in such a way that the last rupee spent on each commodity can give me equal satisfaction. The last 1 rupee, whatever I am going to spend, should give me equal satisfaction. That is marginal utility of the commodity 1, marginal utility of the chocolate equal to marginal utility of the ice cream, marginal utility of the coffee or tea. Like that, last 1 rupee I should spend in such a way that all these 3 products should give me equal satisfaction. All three combination of a product which I have chosen or the commodity which I have chosen should give me equal satisfaction. That if price of the commodities are equal, marginal utilities will be equal. That is called equimarginal utility. Equal marginal utility at my last rupee of spending on a different commodity. What are the basic assumptions of this? You can just see, sir. First rupee I am spending 12 mangoes, 10 milk. Second rupee 10 mangoes, 8 milk. Third rupee 8 mangoes, 6 milk. Fourth rupee 6 mangoes and 4 milk. Like that I am spending. Here the satisfaction is that at a third rupee which I am getting is that 8 mangoes and 6 milk. It is going to give me an equal satisfaction here. Here utility is 8 at a third rupee. Here second rupee 8. So for a 1 rupee, whatever the 1 rupee that I am going to spend now, the equal satisfaction which I am going to get. Assumption is that this is also cardinal utility analysis which can be measured in numbers. Consumer is rational that he wants a maximum satisfaction from the income. So whatever the limited income he is trying to spend on a different commodity. Right? Remaining are the regular assumption. Same quality, same size of the good. Law of diminishing margin utility will apply here also. And no change in the price, no change in the substitute, money is also constant. Next, sir, indifference curve analysis. This is a ordinal utility analysis, which is indifference curve analysis. Keep on typing the assumptions and the properties with me. Assumptions of indifference curve analysis. Assumptions of indifference curve analysis. First, it is a ordinal utility, means we will not be, this is given by Hicks and Allen. So we will be measuring, we will be ranking the commodities, or we will be ranking the goods. Consumer can rank the preference of ordinal utility, like ice cream 1 gave me more satisfaction, ice cream 2 second level, ice cream 3 third, ice cream 4 fourth level. Like that I can keep it in an order. I can tell you this is more satisfied than the other, but I cannot tell you exact number, because this is the order or the preference based, not the number based. Next, consumer is a rational consumer. Always he will try his best to attain the maximum satisfaction. Maximum satisfaction. Number 3, consistency. Consumer is very much clear in the selection of the commodity. Like if he prefers a combination of A over the B and B over the C, his preference is constant. He will not change frequently. Whatever he is going to prefer now, first he prefers, then he will continue the same. He will not be changing. Transitivity, PYQ, means I will choose A over the B combination, B over the C combination, C over the D combination, like that. This is called transitivity. So whichever is higher priority or the higher satisfaction, that I'll keep it in a first priority. So A is more. So ultimately I can say A is having higher satisfaction than B, C, D, which we call it as transitivity. Transitivity. Next is that non-satiety. Non-satiety. Consumer always prefer more of a good. He never reaches to a satisfaction level. He always want more and more, more and more. He never reaches a maximum satisfaction cannot be reached at any time. So that is generally comes under the non-satiety. Non-satiety is another assumption. If these assumptions are satisfied, then only this law will work, which is indifference curve analysis. And there are 5 important properties of the indifference curve analysis. I see slope downward from left to right, like this. I see 1, I see, I see, I see. Slope downward from left to right, like a demand curve only. Right, IC is always convex to the origin. Convex is this. See, this is a shape. This is a shape of convex to the origin. If it is concave, now like this is concave. Production possibility curve will be concave. Production possibility curve. Whereas this is convex. Indifference curve will be like a moon. And indifference curve never intersect each other. Sir, like this, one indifference curve, another indifference curve never be intersected. It will be always like this only. Even though it will come very close like this, but it will never touch. It will never ever touch or intersect with other indifference curve. Next, and higher the indifference curve, Higher the indifference curve, higher the satisfaction. So this is more than this. This is more than this. This is more than this. Higher the indifference curve indicating higher level of satisfaction than the lower one. So lower is lower satisfaction, higher is higher satisfaction. But while doing that one, you should keep your budget also in mind. This is my budget. I cannot say this is higher satisfaction because within my budget, whichever is higher satisfaction, that is higher indifference curve. Fine. Next, IC curve never touches the axis. It will come like this, sir. It will come like this, but it will never touch this axis. Whatever the x-axis, y-axis is there now. It will not be touching. Even though it will come very close to the axis like this. Very close to the axis, it will come like this. But you can find the thin line difference that it will never touch. It will never touch the axis. So budget line. Budget line is here. Sir, this is a price line. Call that as a budget line. Means this is my budget. I cannot go beyond that. I have a 10,000 rupees. This is my 10,000 rupee line. So within the given money and the income which is available, we have to buy the goods at the respective prices. So price of a good one, price of a X divided by price of a Y. This will give you slope of the budget line. The slope how we have drawn? Like this. Slope equal to price of a one good divided by price of the other ratio. And here this price line will give us affordability. All these are affordability. Means where within our budget we can buy those goods. These are all above our budget. Cannot afford this. So above those ICs are not even relevant for our decision. Those are not relevant for our decision. Exactly when indifference curve touching the price line at its minimum point, we call this as a point of tangency. This point we call it as point of tangency. Point of tangency. Point of tangency. Right? So properties of this budget line also, it is a negative slope, straight line, tangent to the indifference curve, and that is a real income line. Real income line. Two commodities will be there, income of the consumer is known, market price is known, all these are regular assumptions. Right, within budget only. This is the equilibrium point where whichever the indifference curve is touching the price line at its minimum point, this is the maximum satisfaction point, this is the minimum, that is the point of tangency, also equilibrium point also. Next, I am starting with the production. Consumer utility analysis completed. Shall we begin? Hello, production analysis now. So Paul Samuelson describes that relationship between the maximum amount of output that can be produced and the input to make that output. Production is nothing but input that is required to make a output which is demanded outside. We call that as a production basically. By using input, we will be making output. So there are four important factors of production. What are they? They require land, labor, capital, organization. Land, labor, capital, and organization. Right? Production function. We have two categories: long run, short term. long run production function is, or long run production theories are, law of variable proportion. Means only one factor is variable. Law of variable proportion, only one single factor is variable. In long run, law of returns to scale, which is economies and diseconomies of scale. Law of returns to scale, that is long run. Law of returns to scale. This is law of returns to scale. We'll talk about economies and diseconomies of scale. Here, when it is only single factor is variable, that is short run, law of variable proportion. When the multi-factors are variable, law of returns to scale, long run. All factors are variable and only one factor is variable. Law of variable proportion. Law of variable proportion. Law of variable proportion. Law of variable proportion states that if we increase a one input, keeping the other inputs constant, a 1 unit of input, then total production at increasing at an increasing rate. Afterwards, it will be increasing at a diminishing rate. Later, marginal production will become negative. That is a regular thing. Because law of variable proportion, only 1 unit we are going to change. Only 1 unit we are going to change. That too, before going into this, let's wait. Wait. Short run and long run production will. Short run production function, long run production function. So let's complete the loss. So law of variable proportion, law of returns to scale. If we are changing a one variable, only one factor, then initially due to that total production, if variable increasing, total production will increase. Stage number 1. Second, variable is increasing. Total production, even though it is increasing at a decreasing rate, slowly, the rate of change is falling down, but it is increasing only. In a third stage, what happens when this input increases? When this input increases, then marginal production will fall down because total production is falling down. Due to that, marginal production will be negative also, even negative also. So in the short run, firm is operating at a normal condition. It will not change anything except a one variable. It will not be changing any other thing. All are fixed. Only one variable is changed. Law of returns to scale is a long run where you can change anything. You can bring the more capital. You can change the organization. You can expand with the land. More land you can buy. We can change all the factors of production. Right. In this, we have increasing, constant and decreasing rate. Another three things. In the long run, all can be changed. Everything we can able to change. That is law of return to scale. Law of returns to scale. So if you look at Bob Douglas, it will law of returns to scale. Three stages. Stage 1, stage 2. Initial stage, total production increasing. And here total production increasing at a decreasing rate. Here marginal production will tend to be negative. If you go to the first one also, the law of variable proportion, and here also the same. But the nature is that short and long term. Ultimately, the impact is almost going to be a same nature wise. Right? Now the production function. Production function. What is this production function? It is the relationship between the input and output. Production function is relationship between the quantity of a productive factor, such as labor and capital, to the amount of product obtained. Means input to the output, which we call it as a production function. Input to the output. Input to the output. Right. This is a PYQ, sir. Production function features are there, na PYQ. Which of the following are the features of production function? Number one, substitutability, complementarity, and the specificity. Substitutability is a factor of production that give you rise to law of variable proportion. One factor I can replace with the other factor. Instead of one labor, I can replace the two labor. By removing a one skilled labor, I can replace with a two semi-skilled labors. So one can be replaced for another. That is substitutability. Ultimately, to increase the production, we are doing all this. Complementarity. Factor of production are complementary to each other. Without the labor, even you have a land, capital, organization, no use. You have to have a labor, land, organization, capital. All together work in a coordinated way, then only production output will come. Otherwise, no output. That is why complementary. Next, specificity. Raw material. Which quality of raw material? What quality of labor? What type of machinery? How much amount of capital? And what type of premises are required? Everything you must specify according to the requirement of production. That specificity is required. Every factor we need to specify what we need for the production. Every factor we need to have a specificity is must. Clarity is must. Because if you can't specify, production quality will fall down. What grade of raw material you want, mention that, specify. Then only production will be a good quality. Substitutability, complementarity, specificity are the three important features. And there are two kinds of production function, long run and short run. Right? Long run and short run. Short run production function is basically a time period. Only one factor is able to change, others are remaining fixed. Right? In the long run, everything is changeable. Your law of variable proportion, law of returns to scale. There is no change in the scale of production here. In short run, we cannot change the scale of production. Here we can change the scale of production. Because in the short run, we cannot take many decisions. You have to work in a normal operating conditions. You cannot change everything. Right? Factor ratio will change over here. Factor ratio. One labor, one land. Two labor, one land. Three labor, one land. That factor ratio can be changed. Here it is not going to change the ratio. And there are barriers for entering in the short run. In the long run, we can enter. No barriers will be to enter. There are three kinds of production function. Three kinds of production function. Number one, Cobb-Douglas production function. Cobb-Douglas production function. And a constant elasticity substitution production function. Leontief production function are the three. Sir, Cobb-Douglas production function is specifying the relationship between the input and output. The formula can be like this. Total production equal to A is which is total factor productivity into labor power beta into capital power alpha. Capital power alpha. So this alpha and beta are the output elasticity of capital and the labor. Output elasticity. Output elasticity it is. So alpha plus beta, both elasticity are less than 1, then returns to scale is decreasing. Returns to scale is decreasing. Both output elasticity are equal to 1, constant return to scale. More than 1, which is return to scale is increasing. Decreasing, equal, and returns to scale are increasing. Leontief paradox function. Leontief paradox function. Leontief paradox is actually, if you want to discuss this, first we need to discuss constant elasticity. Why? Constant elasticity substitution production function. Look at the name. Constant elasticity substitution. It is a mathematical model used to describe the relationship between different input, the factors of production, and the output, which is goods and services. So here, input and output, the relationship between input and the output, factors of production and the output, goods or services. Here, the two factor, which is capital and labor, constant elasticity production function introduced by Solo and all. There are only two factors which are being considered under this also. That is capital and the labor. So if you substitute one in place of the other, how the output is changing? If you substitute capital in place of the labor, labor in place of the capital, how the output is making a flexible production behavior. The value of elastic substitution depends upon the A, value of A. Here value of A is there, which is given in the formula. And marginal products are positive and slope downwards in nature. It is positive and slope downward in nature. If you look at, sir, same like a Cobb-Douglas, but remember the formula that it will come like this. You no need to understand the derivation of the formula. But the formula, A into capital A into small a, capital power beta plus 1 minus A into L power minus P minus beta whole power minus 1 by beta. Or else this formula. If the formula is coming like this is related to constant elasticity substitution. Right? So if beta is equal to 0, then it is same as Cobb-Douglas production function. Inputs are used in fixed proportion. Inputs are used in fixed proportion. If beta is equal to 1, constant elasticity substitution, beta is equal to 1, then inputs can be substituted at a constant rate. And a constant rate, inputs are substituting one with other. If beta is equal to infinity, beta is infinity, and in a fixed proportion, inputs are without any substitution, in a fixed proportion, we use the inputs. We didn't made any type of substitution for the input. In a fixed proportion, we have used the input. That is infinity mean. So Leontief has negated this substitutability function. What the Leontief has done? The Leontief paradox is saying that. Paradox means criticize the constant elasticity. Means there is no substitutability of the factors of production at all. Don't substitute one factor for other. This is opposite to the fundamental rule. And if you are doing as such, it will not be impacting on the production. You cannot replace one with another factor. You cannot substitute like that. That is Leontief paradox, simply. So he has given this formula that Z1 and Z2 are the quantities of input 1 and input 2. The A and B are the constant A, constant B. Not much important anyways. Chalo, let's go to the next part, economies and diseconomies of this. Economies and diseconomies of this. What is it? Sir, economies. Economies of scale occurs when a company increases production. Increase in production and decrease the cost. This is an efficient production strategy. Keep on typing with me. Increases the production at a lower cost. It is the economies of scale. Efficient strategy. Diseconomies means when inputs are greater than the output. Means output is less as compared to input. You are giving more input, 1000 input given, but you are getting only 800 output. So that is inefficient workforce. Inefficient it is. So economies of scale and diseconomies. Economies means advantage, diseconomies means disadvantage. So this is increase in production by lowering the cost. At a lower cost, you are more produced. And here, inputs are more as compared to output. That is a diseconomics. Right. So here, cost is coming down when you are in economics. Cost is increasing when you are in a diseconomics. Now, economies of scale and economies of scope. Scale and scope. What is the difference between this? Sir, scale and the scope. Scale refers to saving in the cost due to increase in output. By producing more quantity, you are saving the cost. Means highest quantity will give us lowest cost per unit. Sir, you invested 1 lakh rupee. By using this 1 lakh rupee, if you produce 10,000 quantity, then it will be how much? 10 rupees per 1 unit cost. And with the same 1 lakh rupee of investment, if you can produce 20,000 quantity, then it will be 5 rupees only. This is economies of scale, where by increasing a quantity of production, I'm just saving my cost. Per 1 unit, I'm reducing my cost. Scope is nothing but economies of scope. It means saving in cost due to two or more distinctive product of the same operation. Two or more distinctive operations of the same operation. Here, I'm saving the cost. In what way I'm saying? This is a scale. And I'm saving my cost with the same 1 lakh rupees. Instead of producing product 1, I'm producing a product 1, product 2, product 3. Similar type of product with the same resources I'm trying to produce. So by diversifying the products, diversifying the production, I'm trying to reduce the cost by producing different kinds of unit, different units, different products I am producing which are similar product. With the same raw material, I can produce different products. With the milk, I can produce the sweet, I can produce the tea, I can produce the any other ingredients which can be eatable. So milk is a common ingredient. I'm trying to produce different products, different commodities, so that I can reduce my cost. Both intention is to reduce the cost, but this is by quantity, we are reducing the cost. Here, this is by producing more distinctive product, we are reducing the cost. Here, the average cost will be, average cost of producing one product will come down. And here, average cost of production of multiple products will come down. This is due to volume the change is happening. This is due to variety it is happening. And this is the old one, this is a new strategy. Here, same product, here different product diversification. We are using the large number of resource on the same product, same resource on the different product. Clear? Scale and scope. Internal economics means only your company related, like expansion of the firm, lower the long run average cost, efficiencies from larger scale of production. All these are your company related. External means outside, which can benefit entire industry, not only your company. Now, sir, marginal rate of technical substitution and marginal rate of substitution. Marginal rate of technical substitution, marginal rate of substitution are the two things. Diminishing marginal rate of substitution refers to decrease in rate at which one input can be substituted for another while keeping output constant as more of input is used. Diminishing marginal rate of technical substitution. Look at technical. Decreasing in the rate of one at which one input can be substituted for another. Whatever one unit we are substituting for another unit now, we are just trying to reduce that substitution. Here, the rate at which consumer can give up some amount of a one good in exchange. If I want a 1 unit of a food, I want to give up 2 units of the cloth. If I want 1 more unit of the food, I want to give up 2 more units of the cloth. If I want 1 more unit of a cloth, I have to give up 2 more units of the food. Like that, if we do, that is marginal rate of substitution only. When we come to the technical substitution, it applies to production process where inputs are substituted to maintain the constant output. Whereas this is consumer behavior theory. This is production theory. Right? Typically shown in negatively sloped curve, the diminishing marginal technical substitution. And this is slope of indifference curve. This is a negative slope, this is an indifference curve shape. Right? In agriculture, as the more labor is high, while keeping the land constant. Land is constant. One factor is one input is constant. And the labor you are engaging more and more. The more additional labor may contribute less to the output. Because for a 1 acre of land, you have to do the farming. If I engage the 500 labor, then 500 laborers are getting a 0.1 like that in a contribution of output. 10 units they are producing. So if I engage 1000 labor, 5 units only they'll produce. Like that, each labor contribution is coming down. So each input contribution is coming down, which is a diminishing marginal rate of technical substitution. Each unit of input that is coming down. Each unit of input contribution in the production is coming down. It indicates the diminishing productivity of one input. As more input you engage, one input contribution will come down in the output. Next, the cost analysis. Production analysis also done. Now I am entering into cost analysis. Shall I? Are we going to complete the economics in single session? Not actually, because market is a lengthy one. After the market, we also start with a various topics like a hair candle index and power index, monopoly power index, HFI, which I have identified new topics, learner index. Many things are there tomorrow to discuss. That is why I'm just emphasizing on this basic known thing much. Now tomorrow will be new topics. The cost analysis, different kinds of cost. What is explicit cost? Out of my pocket, whatever I pay, it is called explicit cost. Means outflow of the cash will be there for sure. Paying a rent, paying a purchasing raw material with a $500. That is a explicit. Implicit means implicit cost. Indirect cost associated with a using self-owned resource. Suppose I have my own house. Instead of renting, I can use my own house for my business. That is implicit cost. Foregoing a rent by using your own property. So if you would have taken rent on a rental basis, you would have been paid a rent. So the rent is now not paying, which is actually an implicit cost. Right? Economic cost. Total cost of all the inputs, both implicit plus explicit put together, it is economic cost. All the inputs, whatever you paid for. Opportunity cost. Next best alternative cost is opportunity. Next best alternative forgone when a decision is made, which is opportunity cost. Choosing a college over the full-time job. Choosing a college over the full-time job means I'm choosing a college means I'm just forgoing the part-time job or a full-time job. Full-time job, whatever salary I'm getting by going to the college, I'm not going to get that. So I'm leaving one to get the another. I'm choosing the best alternative out of the multiple options available. That cost is opportunity cost. Cost that remain constant regardless of the output. Whatever the output that you produce, it is constant, means fixed cost. Variable cost according to the production. If zero production, zero variable cost. How much you produce, proportionately according to the production, variable cost keep on increasing. The cost that change proportionately with the level of production or output. Semi-variable cost. Up to some extent, the cost is fixed, like electricity charges. Till the minimum consumption, cost is fixed. After that, the tariff levels will be changing. Based on the number of units of electricity consumption, the tariff levels will be, slab rates will be different. Like income tax also. Till the 4 lakh income, zero tax. 4 to 8 lakh, like that it is keep on changing. So based on the slab rate, the rate of tax will be changed, which is semi-variable cost. Semi-variable cost. Those who are watching in YouTube, kindly subscribe and hit a like button, sir. So relationship between the average cost and marginal cost. Average cost and marginal cost. The two things that you should keep in mind here. This is one short-run average cost. One short-run average cost. Okay. In one short-term period, this is the curve. When we have, this is for 1 month, assume. 1 month, this is a short run. Now 1 year curve I want, which is a long run average cost. First month short run, second month, third month, first month, second month, third month, fourth month, fifth month, seventh month, eighth month, ninth, 10th, 11th, 12th. Like this, combining all the 12 months curve, I am getting one long run average cost curve. So combination of all the short run curve will put together will give you one long run average cost curve. One long run average cost curve. Based on one short run average cost is only one time period specific. By combining all this will become a long term. So relationship between the average cost and marginal cost. First we should know what is average cost. Average cost is nothing but total cost per one unit. Total cost divided by quantity will do average cost per one unit. Average cost. Average cost itself is cost per one unit. Marginal cost we know the cost incurred for one additional unit of output. That is marginal cost. Relationship is more important, sir. I hope it is visible clearly this chart. Initially, always remember, sir, this is a PYQ 2024 December also question has been. If you look at the relationship, average cost is greater than the marginal cost. Means total cost per one unit more than the per unit marginal. Marginal cost itself is 1 unit. So total cost per 1 unit, that is average cost, is more than the marginal cost. That is why average cost is here, marginal cost is here. Initially this is the AC more than the MC per one. Initially. Number 2. The marginal cost is decreasing while average cost declines. Marginal cost is decreasing now. Yes. And average cost also declining in this. Average variable cost also means variable cost per unit also coming down. Average fixed cost per unit also coming down. So in initial stage, everything is falling down. Marginal cost is increasing while the average cost is increasing. So slowly average cost started increasing, then marginal cost also started increasing. Marginal cost, this is the average cost, started increasing. But the increase in marginal cost is more. Increase in marginal cost, you can see, increase started from here only for marginal. But for an average cost, here it started. So increase in marginal cost is more than the increase in average cost. Increase in average cost. Increase in marginal cost is more than the increase in average cost. Right? So the properties, if you look at, where both AC and MC are U-shaped here. This is what the shape. This is U-shaped, also U-shaped curve. Even ABC also U-shaped. As output increases, both AC and MC are decreasing in the beginning. Later, MC curve, marginal cost is cutting the average cost curve at its minimum point from below. MC cuts the AC curve at its minimum point from below, and after this intersection point, MC is more than the AC. MC is more than the AC. Where AC equal to MC, that will be an equilibrium point here. AC equal to MC is an equilibrium point. So if you look at this MC equal to AC, that will be an equilibrium point where both are intersecting each other. You can approach on WhatsApp number, sir. So if you are looking for APDL Commerce coaching, you can just approach on our WhatsApp number, then you will get all the details. Clear? This is a combination. MC cutting the AC curve from its minimum point at which MC equal to AC, where average cost and marginal cost means total cost per unit equal to additional 1 unit. Now long run average cost. Long run average cost. Different kinds of curves are there. We have first U-shaped curve, most common, Alfred Marshall given, when economies of scale exist. Scale is nothing but we are trying to lower the cost by increasing the quantity of production in the long run. That is economies of scale and diseconomies of scale followed. Is generally a U-shaped curve. That is what here, U-shaped, long run average cost. In a regular condition, this will only come. And always rising. Here, when we don't have a proper economies of scale, means we are not able to reduce the cost of production by increasing the quantity of production. We can't able to do that. In such a case, the long run average cost curve always be rising only. Will be rising only. It is not a normal condition. Right? Continuous economies of scale. You have a full of advantageous position. For a long term period, you have a full of advantage position. Which is decreasing, which means always falling. William Baumol has been given. In a monopoly situation, we can get this. Continuous economies of scale, we can get this. A power grid company experience ever decreasing long run average cost as it expand their network. More and more buildings, if they are giving a power, more quantity will increase, more consumers will increase. So that will be continuously. They are the monopoly. Now, power industry is a monopoly. Private companies can't provide except a solar. To keep that aside. So that will be a decreasing always. Long run average cost. And there is a L-shaped long run average cost curve is there. What is it? L-shaped long run average cost curve. L-shaped. Here, this happens due to sudden efficiency gain at a specific scale, followed by a flat or slow decrease in cost. Specific scale means some specific advantages that we have got. Here, a social media platform is there. Social media platform like a Facebook, Instagram, and all. A sharp drop in long run average cost when they reaches many users. When many users have signed up into their platform, obviously their cost will come down per user. This allows them to leverage their network, increase the value with more users, and spread the development cost. The cost remain relatively flat and decreases slowly. Why? More number of users are increasing here. So, as per the research also, which of the following is a long run average cost curve shape as per the empirical studies? That's the question. As per the empirical studies, which of the following is a shape of long run average cost curve? That is L shape. As per the empirical studies. Empirical studies, research by authors like 𝐐𝐮𝐞𝐫 and Rosenblum, they challenge that U-shaped curve is not going to be common always in every situation. L-shaped is more common in various industries, especially those with a high initial fixed cost and fixed technological cost is there. Their L-shaped is more common than the U-shaped. They are arguing, these researchers are arguing that U-shaped is not common, L-shaped is more common. Like this, the curve is going to be not always be a U-shaped curve. This is a PYQ. As per the empirical studies, which of the following is the shape of long run average cost? That is L-shaped curve. Tomorrow, topics are market, different type of market and their structure, elasticity, all the markets total, price discrimination, and increasing, decreasing order of elasticity of each market, increasing, decreasing order based on their size, based on their features, everything. And HFI index also will be discussed. Learners index also will be discussed. Monopoly power index will be discussed. Monopoly power index, price discrimination and their degrees of discrimination. After that, pricing strategies, pricing, skimming and all is there. Now, pricing strategies. After the pricing strategy, we also discussed this firm theories, Baumol theory, maximum satisfying theory, Morrison, all these firm and profit theories, matching. Here is matching. Like here is matching, and their year in a sequential order will discuss. After that, yes, that's it. I think. These are the areas which are there for tomorrow. Done. So tomorrow we'll meet at the same time again. What is the time now? Now it is 8:14. So before 10 minutes only, I am just concluding the first session. So guys, those who are watching a free session, if you are part of the free session, then if you are willing to take, this is the schedule for the entire revision course in paper one also. Today free session only, evening you can attend the free session today. So you can subscribe to this course in Achievers app, UGC NET JRF. This is how all the units are going to be covered in detail, main points, and based on the PYQ revision will happen. 20 days, this live fast track revision. Recording will also be available after watching a live. Recording will be available for 60 days. So if you want a both papers, 1749 rupees. Single paper, only paper on or only 49. With that extra is that CBT mock test series. For a paper 1, 41 mock tests are available with explanation. For a paper 2, 27 tests are available with. So you can just purchase. This will be a perfect revision at this moment, which can cover all the points. If you sit by yourself, you may not cover everything, but You can attend this one, you can cover many. That is what I can say. Just download 𝐎𝐮𝐫 app from the link given in the description. Or else go to the Play Store, 𝐎𝐮𝐫 24/7. Then you can register, login, go to the UGC net option. The blue color UGC net will be. If you click on that one, first course will be both papers, second course will be one, third course will be only paper. You can choose according to your requirement. Thank you so much. If you have any doubt, you can approach on the WhatsApp number. I hope you enjoyed a revision session, the first session, and it gave you the booster. And it is going to be same like this for the remaining subjects. If you like it, you can hit a like button, subscribe to this channel, join in our Telegram group also. Kindly share a word with your friends regarding the sessions that are being conducted.